Welcome to MindPips, one of the subsidiaries of Adegos Group Limited. I am Igwalikuma Maxwell Adimora, a financial manager, professional analyst and investor in the global digital financial market, and a Forex trading coach. At MindPips, we trade in the global digital financial market, manage client portfolio, and train interested clients on how to trade in the global digital financial market. Today, I'll be taking us through what Forex trading is and some of the concepts about it. Forex trading is the act of buying and selling of global digital financial assets, instruments, and derivatives in the global digital financial market with the use of the computer, smartphones, tablets, internet, and with the help of a Forex broker. Some of the assets traded in the global digital financial market include instruments like the US dollar, the Japanese yen, the Swiss franc, the New Zealand dollar, the Australian dollar, the Russian rubles, South African rands. Commodities include gold, silver, copper, platinum, cocoa. Cryptos include Bitcoin, Litecoin, Doge. We also have bonds like the Euro bonds. Stocks include Amazon, eBay, Apple, Facebook, and a lot of others. We can say Forex trading is the trading of the value of one currency with the value of another currency. For instance, today you need about 1,500 naira to get the value of one United States dollar. Forex trader. A Forex trader is a retail trader like individuals, hedge fund managers, financial institutions who trade in the global digital financial market for the purpose of making profit through what is called contract for difference. Contract for difference is the profit made by traders through the change in the price of assets. For instance, when a buyer buys an asset at a particular amount, there is a seller who has also sold the asset at that particular amount. If the price moves in the direction of the buyer, the seller pays the buyer. If the price moves in the direction of the seller, the buyer pays the seller. Some of the financial institutions who trade in the global financial market include the banks, where you deposit your money. When a customer lodges his or her money in the bank for safekeeping and for the purpose of interest, one of the ways the bank makes money is by trading the customer's money in the global digital financial market. Hedge fund managers are companies with large volume of money from various partners who trade in the global digital financial market. They are one of the major liquidity providers in the Forex market. Retail traders are individuals with little amount of money and leverage on Forex brokers to trade in the market. There are 4 types of traders in the global digital financial market. They include 1. The scalpers. These are traders who trade with the aim of making about 20 to 50 pips per trading position that they take, and they base their trading analysis on the 1 minute to the 15 minutes time frame. Day traders are traders who base their analysis on the 15 minutes to the 1 hour time frame and aim to make about 50 to 100 pips per position they take. Swing traders are traders who trade in the market and base their analysis on the 1 hour to the 1 day time frame with the aim of making about 100 to 1,000 pips per trade position that they take. Position holders are traders who trade in the market for a long term. They trade with the analysis based on 1 day to 1 month time frame. They trade with huge amount that can withstand the volatility of the market for a long period of time. They are usually some of the major liquidity providers in the market, such as the hedge fund managers and the financial institutions. A professional trader is a trader who trades in the market on the basis of professional market analysis, experience over time, and the use of market indicators for the purpose of making profit. Other tools used by a professional trader include robots and AI-enabled systems. The difference between a professional trader and those who call Forex trading a scam is that a professional Forex trader does due diligence in market analysis, comes into the market with good capital, manages his money well, and uses less of Forex brokers' leverage. While most of those who call Forex trading a scam come into the market with little money, with no experience in market analysis, blow up their account because of greed, and at the end of the day, they call Forex trading a scam, which is not true. Some of the analysis carried out by a professional Forex trader include technical analysis, fundamental analysis, and sentimental analysis. Technical analysis has to do with the careful examination of the market structure formed over a period of time. A careful examination of the market structure gives a professional trader a sense of direction in which the market will go, either an uptrend or a downtrend. Also, it gives the professional trader positions in the market called the psychological level, such as the support and demand level, resistance and supply level in the market. Support or demand zone is a zone in the market where sellers of an asset takes out their profit and new buyers come in to buy the asset, causing the asset to appreciate in value and moving in the uptrend direction. Resistance or supply zone is a zone in the market structure where buyers of a particular asset takes out their profit and new investors sell the asset, causing the asset to lose value, forming a downtrend. Before a professional trader takes a trading decision, he carefully looks at the market structure, which is shown by candlesticks, line charts and bar charts, which gives the trader an idea of where the market will likely go. A careful examination of the market structure also gives a professional trader a sense of direction when certain information are released. Therefore, before a forex trader takes a trading decision, he does his technical analysis very well, adds it up with indicators such as the relative strength index, the moving average convergent divergence (MACD), and the Fibonacci ratio, amongst others. Fundamental analysis is the type of analysis where a professional trader analyzes economic data released, political and social events that affect the price of financial assets. Some of the economic data include interest rate, gross domestic product, inflation rate, employment rate, balance of trade, and so on and so forth. For instance, in a high-interest economy, investors in the economy have confidence in the economy as they see the economy is doing very well. Also, new investors will come into the economy to invest, therefore causing the currency in that economy to increase in value. In a low-interest economy, the economy is perceived to be weak, causing investors who are already in the economy to lose confidence in the economy and discourage new investors from coming into the economy to invest, thus causing the currency of that economy to weaken the more against its peers. Employment rate. An economy with high employment rate is seen to be a strong economy. This boosts the confidence of investors who are already in the economy and also attract new investors such as foreign direct investors to come into the economy to invest. This causes the currency of that particular economy to rise in value against other pairs. Balance of trade. This has to do with the import and the export of a particular economy. When the balance of trade of an economy is in surplus, the economy is seen to be strong. This boosts the confidence of traders who are already in the economy, and it attracts new investors to come into the economy, thus causing the currency of that particular economy and stocks in that particular economy to appreciate in value against other pairs. On the other hand, when the data released shows a deficit in BOT, it causes already existing investors to lose confidence in the market, hence causing them to pull out their money, and it discourages new investors from coming into the economy. This further weakens the currency of that particular economy against its peers. Consumer price index or inflation rate. When the inflation of an economy is high, the economy is seen to be weak. This discourages already existing investors from investing in the economy, and also it discourages new investors from coming into the economy to invest. This causes the currency of that particular economy to weaken against its peers. When the inflation rate is low, it shows the economy is strong. This gives confidence to investors who are already in the economy, and it attracts new investors to come into the economy to invest, therefore causing the value of the currency of that economy to appreciate against its peers. Gross domestic product, GDP. A high gross domestic product is good for an economy as it shows that the economy is strong. This causes already existing investors to have confidence in the economy and invest more, and also attract foreign direct investors to come into the economy to invest, thus causing the currency of that particular economy to appreciate in value. Also, when the gross domestic product GDP of a country is low, it shows the economy is weak. This discourages already existing investors from continuing their investment, and also discourages foreign direct investors or new investors from coming into the economy to invest, thus causing the currency of that particular economy to weaken the more against its peers. Lastly, professional traders pay attention to leaders of central banks of leading economists in the world when they speak. For instance, Jerome Powell of the United States Federal Reserve, Pang Gongcheng of the Bank of China, Michelle Bullock of the Reserve Bank of Australia, and Andrew Bailey of the Bank of England. Geopolitical events that affect the price of financial assets include elections and change of government, war, and other natural disasters. During a change in the leadership of a country or regional institution such as the EU, the IMF, and the World Bank, currencies in this region or country seem to be affected by the change either by election or selection. This is because traders are pessimistic. They are not certain of the economic policies that the new leadership will bring in the country or the region. For instance, during Brexit, the value of the Great British Pound fell because traders were pessimistic and they were not sure of the future of the United Kingdom and its allies. During political instabilities and war, such as the war in Russia and Ukraine, Israel and Gaza, the currency of that particular country and its stocks suffers because traders are pessimistic and are not certain of the future of the country. Other social events that affect the value of a currency include natural disaster like earthquake, hurricane, tsunami, flood, and so on and so forth. Sentimental analysis. Sentimental analysis is the analysis of the mood or perception of other traders in the global digital financial market. The mood of the market is usually determined by the information that is released or the structure of the market. Risk on and risk off market. A risk on market is a market that is perceived to be positive as it is reacting to a bit or a positive news that is released. During this period, traders are willing to risk their capital in highly volatile, high beta currencies such as the Great British Pound, the Euro, the New Zealand dollar, the Canadian dollar, and the Australian dollar. During this period, traders tend to pull out their investment from safe haven assets and currencies like the gold, the United States dollar, the Japanese yen, and the Swiss franc. In a risk-off market, the market is perceived to be negative as it is reacting to a miss or negative news. During this period, traders are pessimistic and are unwilling to invest their capital in highly volatile assets. They rather trade in safe havens such as the United States dollar, the Japanese yen, the Swiss franc, and gold. Mixed market. A mixed market is also known as a ranging market. This is because the market is neither positive or negative, and traders are unwilling to take trading position as there is no much information for them to do so. Capital and capital management or risk management. This is a key area in forex trading. The amount of capital a trader comes into the market determines the amount of leverage he or she will take from the forex broker. The higher the capital the trader comes into the market with, the lower the leverage and the safer for the trader. On the other hand, when a trader comes into the market with very little capital, he will depend on the leverage provided by the forex broker for him or her to trade in the global digital financial market. The risk management. This is a key area in forex trading. The ability of a trader to manage the risk level that he takes per trading position determines the success of the trader. For instance, traders are advised not to risk more than 10% of their capital in a single trading position. A trader with $500 is expected to open a trading position with not more than $50 per trading position. A trader with $1,000 is expected to open a trading position with not more than $100 per trading position. Psychology in forex trading. This is an important part of forex trading. A forex trader is expected to be psychologically fit before he takes a trading decision in the market. Some of the psychology include fear, hope, greed, and regret. When a trader is afraid of losing his or her capital, he or she ends up not taking the best trade when they show up. At the end of the day, he takes trading positions that makes him or her to lose his or her money. Also, the fear of losing out. For instance, a trader just jumps into the market because he sees a bullish momentum or a bearish momentum, not paying attention to the level at which the trend has gone. For instance, a trader taking a buy position in an uptrend with a 4-hour time frame that is reading 92 in the relative strength index indicator. At 92 on 4-hour time frame, it shows that the market will soon make a turn to the bearish momentum. Therefore, a trader is not expected to just jump into the market and take trading decision without doing due diligence in market analysis. Greed. Greed is also a factor that is very important in forex trading. Greed comes into play when a trader wants to make huge profit in a short period of time or very few trade positions that he or she takes. This will cause the trader to open trading position with very big lot sizes that his capital cannot withstand, thus causing the trader to lose his or her money, or what is called blowing off account. Hope is not a strategy in forex trading. A trader is not expected to just jump into the market hoping that the market will move in the direction he or she has speculated. Before a trader takes a trading position, he does his market analysis very well, uses the market indicators, robot and AI if they are available, before taking a trading decision. It is after you have done due diligence before you hope that the market will move in your direction. Regret and gambling mindset. This comes into play when a trader loses part of his capital and he wants to make that part of the capital back by all means. This causes the trader to take unnecessary trade positions with lot sizes that are unreasonable. Before I go, here are my parting words. Remember, patience is key. Don't buy in a bearish trend. Don't sell in a bullish trend. Make the trend your friend, and the profit will be yours. Thank you, and see you next time.